Hey everybody, welcome to February 2nd's MakerDAO community call. My name is David Utrobin. I am a community development community development lead here at the Maker Foundation and a longtime MakerDAO community member. And I have the good pleasure of facilitating these things every week. And so this one is going to be really fun. We actually have quite a few guests, so I'm going to start inviting them on screen. But the subject of today's community call is actually the surplus buffer. And if you are wondering what is the surplus buffer, well, essentially it is like the current amount of DAI that the protocol is just holding in reserves that it's received as revenue from all of the liquidation, stability fees, etc. And the number on that has been kind of a topic of discussion for pretty much as long as it's been there. And today we have a number of really, really great people to talk about where it's going, different theories on how to manage it, how to look at it from a risk perspective versus a business perspective, preparing for the protocol to cover its own expenses and how that relates to the surplus buffer, et cetera, et cetera. So there is a lot to talk about. So I am going to be inviting on screen Sebastien Derivaux, who was recently actually voted onto the risk team as a risk team facilitator. So welcome, Sebastien. I also have Primoz Kordez coming on. He is actually one of the risk OGs at Maker, so he's going to be coming on in a second. I believe Shupi, did you also want to come on screen? There's Sam. Gonna invite Shupi and right. So yeah, they are coming on the screen. I see that they've accepted and they're in the process of connecting. So there's 3 people connecting. Yeah, there we are. Hey, what's up, Tim?
All fine. Just some fireplace chat for today.
Nice. I like it. It's a nice laid back vibe to talk about really cool decentralized finance stuff. Yeah,
hey guys,
no problem. Yeah, I could hear you, Sam. I'm inviting you on screen one more time. Primoz, give me just a second.
Can you hear me?
I can, yeah.
Cool.
All right, invite is sent, Primoz, so should be there.
Can you hear me?
Yes.
Cool.
I can hear you, but I can't see you. I wonder if I toggle my video, if you come up. No. Yeah, oh yeah. Okay, I just see your emblem.
How do I mute myself or unmute?
Oh. So if you scroll over, over yourself, you should get like a little panel with a bunch of controls.
Yeah, got it. Thanks.
No problem. All right, cool. Well, welcome everybody. I guess maybe for like these first few remarks, I would love for everybody to just introduce themselves and kind of talk a little bit about, who you are at Maker and why you're interested in this conversation.
Sure, I can start if you want. So I'm Sebastien. I'm a risk facilitator for Maker, and I'm currently applying for a core unit which is called real-world finance that explore a lot of traditional finance concepts like capital, like equity, like all those stuff, and try to apply them to MakerDAO. And the other way is other true to let the rest of the traditional finance know that we are the solution of every problem, because the solution of every problem is MakerDAO. And that's about it. So I spent a lot of time talking about accounting and stuff like that, because I think it's important for the DAO as well.
We're glad to have you, Seb.
Hey everyone, I'm Primoz. I'm the second risk facilitator. I think since October last year. I think I'm at Maker now for about 2.5 years. Previously, we worked on risk with Cyrus. Currently, it's basically our team. We're working on, proposing risk parameters for Maker, risk evaluations for new collateral assets. What else? All sorts of risk-related stuff. Mostly focused on crypto collateral. But yeah, that's it about it.
I can go next.
Yeah, go for it, Sam.
Hey, I'm Sam MacPherson. I'm the smart contracts facilitator now. I've been working with Maker since I guess I started in August-ish, September. But I've been part of the community, since like 2018. Yeah, so I do smart contract development, just general community engagement stuff as well. I came to Maker from a different route than some of the other smart contract developers, in that I have not worked for the foundation, so I'm a community smart contracts person. So I work on some different stuff.
Sam, you were behind the PSM and also the DAI Flashmint module and a number of other really awesome stuff that happened this year.
Yes, that is correct.
I guess it's my
Yes,
turn,
it's
right?
your turn, Tim.
Okay, hi, my name is Tim. I think I bought my first Maker tokens and opened a CDP by the time in the end of 2017, and since then have been lurking in the forum. And yeah, I got into the habit of spamming the forum with signal requests in the, I don't know, last couple of months. Trying to get more and more engaged into the whole thing because it's great.
Yeah, you've actually been spearheading the signal requests specifically for the surplus buffer too, which is why it's really great to have you here in this discussion.
Yeah, well, it's just one of the topics. I think it makes sense to engage from the community perspective as well. So it's not only about the inner circle of people who are really tied to the foundation or now to the core units or however you would call them. But yeah, I think everybody could take part in this journey. And yeah. Voting for a long time. So it's the next stage is, beside voting, is also starting or kicking off initiatives. Yeah, like to do that.
Totally. Well, welcome to the chat, everybody. So I think a good place to start is kind of to set up the historic view of the surplus buffer and what the surplus buffer was, and how it's been viewed up until this point. Does anybody want to take a stab at that?
I can try.
Yeah,
I can try, but I'm not sure if I can remember where we started. But I think in MCD, when we started before the Black Thursday, I think we had surplus buffer of about 1 million. I think so. And then we had the Black Thursday, right, which amounted to about 6.5, I believe so, millions of losses. And we soon realized that the surplus buffer may not be sufficient, right? At that time, the DAI supply was around 100 million, and we had 1% in reserves in that sense. So there was some kind of push to, this could happen again, and higher surplus buffer is needed. And I think we increased it to 2 million right after Black Thursday. And so on it went, right? When the DAI supply was increasing, on risk side, we were kind of pushing for a higher surplus buffer. There was this notion of possible losses and what it means, why this hedge is good. But on the other side, there was also always some kind of push for make or burn, for flap auctions. So yeah, here is where we are. Maybe that's something for a next discussion, what it all means. But yeah, a bit of background.
And it's interesting because when the surplus buffer was raised to 2 million, that's when we had, as Tim pointed out, about 100 million DAI. And since then, over last year, we've increased the total DAI supply to almost 2 billion. Like, we're sitting at 1.6 billion DAI right now, and the surplus buffer did not go through a similar 10x plus increase. And so that's kind of where we are now. Yeah. And so maybe like a good first question would be, how should we view the surplus buffer from a risk perspective? Does anybody have yeah, go for it.
Yeah, I'll try to be quick. So the way I see, Maker has few lines of defense. the first one is, of course, managing risk parameters, right? So how we defend against losses is we can simply limit the debt exposure. We can set different liquidation ratios. We can even increase rates. And this is the first line of defense where we need to be cautious. The second line of defense, before it comes to losses, is probably, we have few tools. One of them is circuit breaker. So this is already when we have a crash and, we could see a large amount of losses, but we can defend against it. So one of those tools is circuit breaker. Second one would be Oracle freeze. Maybe there's another one and I forgot, but this is how I see it, like in some kind of correspondence. And then the next line of defense is surplus buffer. And this is, the line of defense when the losses are already generated. And we need to set it properly. And of course, the next line after this, the next line of defense is maker dilution. And the last probable outcome is just emergency shutdown when it's already too late. And how I see surplus buffer from the risk perspective is as such. So first of all, there needs to be some notion of losses that we want to be hedged against. Community needs to, basically set some value with which it wants to be hedged against. So let's say we had a presentation last month. We proposed we estimated some value at risk numbers. Value at risk is pretty common financial term to, show the value of the tail event losses. But at the end, it really depends on community risk appetite. So in banks, they use, high value at risk, 99 percentile and even higher. At Maker, this really depends which one would you want to take. For instance, if you think that our estimates are too conservative, maybe a 50 or 60 percentile value at risk is something that Maker community wants to be hedged against. And let's say, this comes to a number of 50 million. And then somebody needs to ask himself, okay, is this the surplus buffer that we want to have, that we want to be protected against? But, then it comes to trade-offs, right? And the most important trade-off, probably the core of our talk today is, how high do you want to go with surplus buffer? Because if you go too high, there are some downsides as well. And if you go too low, there are downsides as well. And here's the thing, like if we want to be protected, let's say against 40 million loss event, and we set surplus buffer to 40 million or even 50, there's downside. And the downside is that this money that's being hoarded in the protocol is actually not making any yield. Whereas if you do surplus auctions, Maker holders can get some of that cash flow indirectly through buy and burn, and they can basically invest that money. So yield-wise, for Maker token holders, it may be better to keep a lower surplus buffer. And some are, of course, probably because of that, they were insisting on lower surplus buffer. On the other hand, if you have too low surplus buffer, you have the other trade-off. And this is when you have a loss event and the surplus buffer is not high enough to cover these losses that you kind of want to be hedged against and they're somehow expected, you need to make Maker dilution. And this dilution can be really expensive, right? Because when prices crash, Maker price also crashes. And when you raise money, you're raising money at probably at the worst time, right? So this is how I see, from the risk perspective, but this already touches on the business perspective, which will be obviously our next topic in some sense. But that's like the main trade-off that I see.
Yeah, that's really, really, really well framed. And actually, I wanted to dive into one of those downsides for when there's too much DAI in the surplus buffer. You said that a part of it is the opportunity cost of not being able to put that DAI to use. And I know in the forums, the community has proposed using this new piece of code called the keg to actually stream payments to potentially even other reserves in the protocol besides the surplus buffer, like Seb's proposed strategic reserves fund, or even like a separate reserve for operating expenses, for example. Do you see that as a workaround to this issue of having too much DAI in the surplus buffer? where you can basically have like a smaller amount of DAI in the surplus buffer, but still have like other DAI that you can employ in other ways.
Yeah, so maybe if you want to agree, I have made a few slides to explain the situation and to explain the difference between what I thought the strategic reserve was a good solution and why I think now that it's not a good solution.
Yeah, sure, go for it. Share. You should be able to.
Yep.
Yeah, there it is.
Do you still see the slides? Okay, so just a bit of accounting, but you will see it's really simple, but it's really important to understand what we are doing because we are speaking of DAI, but most of the time when we say there is some DAIs in the surplus buffer, there is not a single DAI in the surplus buffer. There is an amount of stuff that is measured in DAI, but you can say dollars, it will be the same because it's not DAIs. So just two quick rules of accounting, and you will be an accountant like no other. There is two concepts in accounting. It's the assets and the liabilities. So assets is what you own. If I own one DAI, I have one DAI in my wallet. And the liabilities is how you finance that. So it's the difference between your assets and your liabilities. It's called the equity, which is the net worth you own. So for instance, in the wallet, the balance sheet on the right, it's let's say it's my current wallet. So I own on the asset side a lot of ETH. I financed it a bit using a Maker loan. So I asked Maker to loan me some money, depositing some ETH that are on the asset side. But that allowed me to have leverage exposure to ETH. And the rest is my equity, which is my net worth. The amount you have when you are using Ethereum and what is the value of your wallet. And there is a simple rule, is that so two simple rules. It's the equity is always different between the assets and the liabilities. So it moves if you change anything. And the assets are always equal to liabilities plus equity. You cannot have one side bigger than the other. So if you increase one, you should increase the other. Let's start at the beginning of Maker. At the beginning, there was nothing. Maker was a simple wallet, an address. Let's take the surplus buffer, the WoW was an address, and there was nothing. And Maker can create DAI, which is a promise of Maker to pay $1 of assets at the emergency shutdown. And only Maker can create DAI, which obviously makes sense because if everyone can create DAI, Maker will have a lot of liabilities. So you can create a lot of DAIs if you are Maker. You increase your liability side, and you have the same amount of DAI on the asset side. So you own yourself an amount of DAI, which is quite useless because if I own myself $1 million, I'm not richer at all. So that's just to explain that you can always do that. It's interesting because sometimes to explain stuff, it's easier to do this that way. But usually, we always put the net balance between the assets and the liabilities for DAI. So let's say I'm Seb, so I have some ETH, I have an equity, and David has some ETH as well, and so he has some equity. And Maker is here doing almost nothing. But David wants to decrease his exposure, and myself, Seb, want to increase his exposure. So we will use Maker for that. So at the origin, only we both own ETH in our wallets. And you can see at this stage, I can create a Maker loan because I'm using a Maker Vault. The details are not important, but I can create the same liability and the same assets, a Maker loan, so from the Vault number 1. And Maker can create DAIs on the assets and the liabilities. And with a simple swap, Maker can buy the Maker loan I have and provide me some DAIs. And now I have some DAIs. Maker has the loan on the vault, and I can use those DAIs to buy the daily ETH. So that's how it works, simply. And what happens when time increases? You know that there is some accrued interest on the Maker loan. So let's say this is my new balance sheet, and I have the Maker loan number 1. If I wait a little bit, the Maker loan will increase the value. So my equity, my net worth will be decreasing. I hope not, because I hope ETH will be increased. But if ETH doesn't increase, my equity will diminish. And the Maker balance sheet, the value of the loan increase as well because of the accrued interest. The liabilities of DAI doesn't change because DAI doesn't accrue interest. So by using the simple rules that what is left is the equity or the net worth, or what we call for Maker the surplus buffer, we are generating the surplus buffer. And so that's the cool stuff with Maker, is that we are creating some money. And we say that the surplus buffer is an amount of DAI, but if you look on the asset side, there is not a single DAI, because it doesn't make sense for Maker to own DAI on the asset side. And for instance, when we try to buy and burn MKR token, we start from the left position. We will create some DAI on both on the assets and liabilities, just to explain it first. We swap DAI for Maker, and then we will burn the Maker side, so it will diminish the equity. Because you cannot say that, oh, I have some DAI liabilities, but let's pretend it doesn't exist. No, we cannot do that. So the only thing that can change if we burn Maker is that we decrease the amount of the surplus buffer. But the decreasing amount of surplus buffer is a consequence of burning the MKR. It's not the consequence of or the source of value to buy the MKR in the first place. And that goes through why it's better to use the Maker balance sheet versus using the strategic reserves. So on the right, it's what can be done using strategic reserves. So we have some amount of Maker loans. So all the vaults we have is A, is B, and so on. We have some DAI generated, so that are outside of the system to other wallets. We have some surplus buffer, and we can take some of this surplus buffer and put it in what we can call strategic reserves. And we can buy some assets with that to put those assets at work. But if you look on the balance sheet on the left, you can see that with the same situation, the same amount of Maker loans and the same amount of surplus buffer, if you just take the surplus buffer plus the strategic reserves equity, we can buy a lot more of assets. And why is that? Because if you are using Maker, we can mint some DAI to buy some assets. And it's not unbacked DAI because there are something on the asset side. We have still a lot of equity. And this provides us a bigger surplus buffer if something bad should happen on the Maker loans or on the asset side.
I do have one question just to help clarify for me.
Yeah.
The surplus buffer is on the liability side because in the event of an emergency shutdown, that DAI gets distributed to well, not that DAI that gets distributed, it's more that DAI gets taken out of the amount of the collateral value that gets distributed in the event of an emergency shutdown, right?
Let me check if I can. Yeah, let's take this slide. So what happened? Let's say currently we are in this situation. What happens if there is some loss because we have ETH that fall down in price, liquidation doesn't work for any reasons, and the value of our Maker loan book is decreasing.
Mm-hmm.
So this is decreasing a lot, let's say a lot. And what you can see, let's say we start with this. And then you can see that the assets and liabilities are not the same size. And there is a rule that should always be the same amount of assets and liabilities. So that means that the surplus buffer will shrink.
And you're illustrating losses, basically like a Black Thursday event where liquidations can't raise the amount of basically can't catch liabilities. Yeah.
You cannot get back the amount that the maker vaults are owning to maker.
Right.
And if you lose too much money, you can see that the surplus buffer is going to 0. Actually, it's going to negative. So that means that you have a negative equity. And to fulfill your promise of having $1 of assets as emergency shutdowns for each DAI, you need to raise some new DAI on new assets. Basically, what you are doing is you are printing MKR token, selling them for DAI, and as you get more DAI, so you will buy some DAIs by minting some MKR tokens. It will be something like that. And as we have defined that it doesn't make sense to have DAI on the asset side, we just remove this part, and remove this one.
Right. Thank you. That was a really good illustration. I think there's a couple of questions in the chat. So Juan asks, surplus buffer hasn't been collected yet. The user hasn't paid it yet, right?
Yes.
But functionally, the protocol can pull that out of the surplus buffer, right? Like we can use it functionally as DAI, even though technically the user hasn't paid it yet. It is like actively accruing and can be used as an asset, right?
Yeah. So the surplus buffer, if you have 3 million of surplus buffer, that means that you can mint 3 million DAI and burn the asset side, like paying people for 3 million, like burning MKR for 3 million. At the end, you will no longer have a surplus buffer, but you will have more DAI. Which happened, for instance, here, because you start with a big surplus buffer. You decide to create DAI to buy MKR and burn some MKR, and you end up with a smaller surplus buffer. But that's because you are burning the MKR, because if you keep the MKR token, that doesn't change. The surplus buffer is still the same. If you have a 10 million buffer here, you still have the 10 million buffer here.
David, you're muted.
Oh no. Yeah, sorry. I was just reading Peyton's question out loud. So when someone pays back their loan, our balance sheet just shrinks.
Yes. We can illustrate it here. Let's say if someone is paying a loan, so he will bring some DAIs into the system. In exchange, we will diminish the loan we have on him. So it will be something like that. And again, as it doesn't make sense for Maker to have to own some DAI, we will remove this DAI, let's put it here, and decide to diminish our liabilities. And this will be the new balance sheet. David, you are again muted.
Sorry. Yeah, this is a really great illustration. I think wrapping my head around the balance sheet view of the Maker protocol has been something I've been trying to do for many months, and you do a really great job here to show what it looks like in practice. And so bringing it back to actually the management of the surplus buffer and referencing some of the things that Primoz said about the downsides of having it too large and the downsides of having it too small. Where do you stand, Seb? How do you think the surplus buffer should be managed at like at above 1 billion, 1.5 billion DAI liabilities?
I think it's not so much an amount even relative to our balance sheet. The main trigger is how many times do we want to have an MKR dilution? Is it once a month, once a year, once a decade? I'm one each decade. That's enough for me. Because every time we will dilute, sometimes it will work well, and sometimes it will just fail, and you will dilute at market price of Maker, let's say $10 per MKR token. So that's not great. But what is important is that on the asset side, we have some diversified assets that don't fall in price at the same time. And that's super important. Because if we only have ETH on the asset side, ETH loan, like we have currently, if ETH price fall and liquidation doesn't work, we lose a lot of money. 200 million, 100 million, we don't know exactly, but a lot. If we have, let's say, 50% ETH loan of MakerVault's ETH is A, if we have some real world assets, it's unlikely that those will fall in price at the same time. So we can have a smaller surplus buffer. And that's why the risk should decrease by diversification. And again, we can compute, you can make, it's never perfect, but you can make a decision, let's say, we want to dilute Maker holder only once per decade and find what is the best optimization for that. Because obviously, if the surplus buffer is too large, you lose leverage.
You lose what? Can you repeat that?
You lose the leverage. So what we are doing is we are leverage farming. Because the Maker equity is only the surplus buffer part. So if the average asset yield is 2% and you have a 50 times leverage, which is now currently we have 200 times leverage, I would say. Yeah, something like that. So that means that by making 2% on the asset, as we have 100 times leverage, we are making 200% return of investment on the equity of Maker. So we are making the best farming of all time. And maybe that's a bit too risky. Because 200% is not sustainable even in DeFi.
Yeah, I would love to open it up to the other people that are live on the call. I feel like I've been hogging the mic a little bit.
Yeah, I just would like to bring in another perspective as well. I mean, right now we don't have the CAC, we don't have the strategic reserves. We basically, the only thing that we have as a tool to prevent Maker dilution is the surplus buffer. And I mean, from my perspective, it's kind of a twisted story because at first I was totally against raising a surplus buffer because I wanted us to get back to 6 digits again. But now as we are there, I would rather invest all money that we have on growing like hell. And I mean, if you would compare Maker with a normal company, a non-crypto company, you would not expect some kind of buyback and burn program. And we shouldn't, and from my point of view, we should just try to grow as hell. And by the point of time we are unable to basically spend money on crazy marketing actions or whatever, or just going crazy on providing low fees and going very high on the debt exposure, then we can start burning Maker. But not before. And so as we don't have the CAC, as we don't have the strategic reserves or anything else, we should desperately try to basically increase the surplus buffer as long as possible, because we can always go back on a lower level again. So as soon as we have strategic reserves or a CAC or whatever, then we can easily go back. And I mean, looking at the latest signal, I'm pretty happy that a lot of people are fine with raising it by 20 million. But I'm kind of disappointed that there are still so many people wanting to burn Maker tokens, because I think it's basically we are missing an opportunity to grow like hell, because this is what we should do as a product right now. So it's not only about risk, and this is the hardest part for me to wrap my head around all those risk parameters, because I'm not really an expert on this topic. But it's not only about risk, it's also about preventing the buyback program, which we should not do right now, from my point of view.
Yeah, I mean, I pretty much agree with everything everybody's saying here. I don't really have much to add. I think it's a good idea to grow the protocol as well, especially now that we've entered into a bull market, in my view. Fill up the coffers while we can and prepare for the hard times. So yeah, don't really have anything to add.
Yeah, thank you for those comments. I definitely think that you're right on point, Shupi, and I think the sentiment that I've been seeing in the forums has been mostly in agreement that buy and burn and then also Maker Dilution are kind of like, it's a very inefficient system naturally, because you end up buying MKR really high and burning it, or you end up selling MKR and diluting yourself really cheap. And so it just seems like a not efficient way to spend like company capital. So yeah, there's definitely a matter of business interest involved in raising the money that's being raised in the surplus buffer. And we are in a moment right now at the Maker protocol where we're making, I think, north of $40 million a year being accrued into that buffer.
It's going to be higher than that soon enough, with the fees going up as well.
Yeah, and accounting also for liquidations and all the other revenue streams.
I just want to mention there was a benefit to having buy and burn. Like, it's not a total nonsense. When we had a high DAI price, higher pack, it was actually beneficial, right, to be selling DAI. Currently, it doesn't seem this would be a real issue, although we still have stable coins in portfolio, but this is not something that's really beneficial as it was in the past. And also, Maker price is higher. Making buy and burn now is probably not as efficient as it would be otherwise. So yeah, I'm also in a camp to raise surplus buffer, but I'm a risk facilitator, so obviously we're gonna want that.
Yeah. So there was talk about potentially putting an instant access module on the surplus buffer and creating some logic around automatically adjusting it. Do any of you think that this idea is premature, too early, a bad idea? I'm curious what everybody's view is on that.
I personally believe it's not as, maybe it's premature, but it's, how would you set the surplus buffer? Basically, it should be percentage of some sort of risk-weighted collateral portfolio. So for instance, let's say you grow on, let's say 6 months ago, you would say 3%, but then you start including stablecoins in the collateral portfolio. Now you would question yourself, does it make sense to raise surplus buffer because you have 500 million of stablecoins? In some sense, yes, but it's not, surplus buffer doesn't hedge against, USDC failing. So percentage-wise, it doesn't make sense unless you do proper risk-weighted metric of collateral, which is basically what we're doing, right? Value at risk metric is doing that, right? When we measured it per collateral type, we saw that the highest increment on value at risk number comes from ETH vault, which is logic. Now, I don't imagine how we can put this into a smart contract to say, calculate all these simulations, value at risk, and then say, we're going to take this confidence level, and then let's say, there's 50 million we want to be hedged against. and this is the surplus buffer that we want. Or just, part of that is going to be a surplus buffer because we might want to have some dilution at the end, like in worst cases. So I can't imagine how to put that in a smart contract, the whole process. But if we come up with value at risk metric, something that's refreshed, we can basically, by asking community how much you want to be hedged against it, we could see what's the surplus and then just set surplus accordingly, and that's it. This is probably the easiest.
Yeah, I would like to echo that sort of premature. Maybe it's useful to do later on, but especially with smart contracts so limited with resources right now, doing these things manually until they become frequent enough that we should spend time to optimize it. I think it's infrequent enough at this point. Like we've done it twice now, 3 times, adjusted the surplus buffer. It's not enough to spend smart contract dev time optimizing, I don't think, when we can just do it easily enough manually for now.
That makes sense. I see Peyton has a question for Seb. What kind of real-world assets are your priority for ensuring we aren't stuck increasing the buffer constantly?
So it's not only real-world assets, but everything that is uncorrelated to ETH, and more precisely than ETH, because ETH is not the problem. When ETH goes up or down, it's not a big issue. It's only when liquidation fails that it's becoming an issue. And whatever is not correlated at all to that is good for us. So it can be real estate, loans, always loans mainly. But if we can have, for instance, the PSM, we are having some USDC on our balance sheet, and we are making a little spread by selling and buying USDC versus DAI. So that's using a little bit of our balance sheet. Well, maybe not more than a little bit, almost 100 million, but that's generating revenues. But there was no link between having USDC on our balance sheet, that is doing almost nothing, and having ETH loan. Because if ETH goes down, probably USDC will not change at all. And on top of that, there is some work to use this USD we own on our asset side and put them on compound and earn a yield. That means that we'll increase the risk, the protocol risk, let's say, of compound. But is the protocol risk of compound related at all to a sharp decrease of ETH price? Maybe, maybe not. That's something to make. So anything that is not correlated to the bigger risk is overall not increasing the overall risk of Maker and doesn't require to increase the surplus buffer. But it adds on revenues. So we can increase the revenues while keeping the same risk and the same surplus buffer. And that's what we need to optimize.
So if I'm understanding you correctly, an example would be giving a vault type to a dedicated real-world asset manager, right? Like Centrifuge.
Yes.
And giving them that line of credit. And because we know that liquidations and all the recourse and everything is sort of contained and special for that product, you account for that completely differently in the surplus buffer than you would for ETH or others, because you're really measuring just the risk of the failure of the liquidation system, the risk of losses, right? Am I kind of understanding that correctly?
Yeah, it's kind of that. That means that if you have a surplus buffer, or let's say 100 million, and a balance sheet of 1 billion, and you have 10 asset classes, ETH loan being one of the asset classes that are fully uncorrelated, meaning that you don't lose money on only one at a time, you will never create MKR dilution. And the risk is the same if you have one asset class of 100 million or 10 times this amount. If you have 10 asset classes that are uncorrelated, you are earning 10 times more cash, but not increasing the risk. Obviously, in real life, it doesn't work because nothing is fully uncorrelated, but That's the idea. And clearly, having using New Silver, for instance, which is using real estate loans, is not correlated at all to the ETH price, and not to the liquidation issues on the ETH.
Yeah, the diversification benefit of just having a ton of different vaults, asset types is really, really good. And it basically doesn't scale linearly with the surplus buffer. Like the more diversity, the surplus buffer kind of almost not flattens out, but it doesn't have that same curve. Yeah. So I'm actually curious about the USDC that's on the Maker protocol balance sheet that's sitting in the PSM. So Seb, you mentioned a bit about eventually being able to earn a yield on that. I was curious if that USDC can be counted towards being employed in the event of losses. Like let's say Black Thursday happened again, surplus buffer disappears, goes negative. Is that USDC like usable as a tool in that event to kind of to get away from MKR dilution?
Sadly not, because you always account for the USDC on your asset side. So if you lose 100 million on the loans, you still kill the surplus buffer 10 times, and you still have to find some equity, some capital. But what you can do, and it's already made with the PSM, is sell those USDC if the DAI price is going too low. So we have the PSM is a great tool to avoid the DAI price to be too above or too below $1.
Got it. But are those USDC they're on the asset side of the protocol balance sheet, right?
Yes.
Got it. Okay. I still kind of don't really understand why we wouldn't be able to like sell them for DAI as the protocol to cover losses.
Yeah, if you want, we can try that. I will share my screen quickly. So let's do that. So we have the Maker balance sheet. So we have a lot of loans, and here we don't have an asset, it's USDC. The PSM is growing a lot, and half of the balance sheet is USDC. So let's pretend that you lose a lot of money on the Maker loans. So this will shrink. It will follow, and the surplus buffer will diminish accordingly because it's the difference, and we cannot change the size of that. If it's continue to decrease, you can see that the surplus buffer is disappearing, and we need to print some MKR token to buy some DAIs because we have too much DAI liabilities.
Mm-hmm.
So we need to buy back some DAIs. And the fact that we have some USDC, we can use them to buy DAI. So we can use all those USDC and diminish the DAI side, but there is still the same difference.
Ah, interesting.
But obviously, having you can see that I was having some issues because here we have the USDC that doesn't change if there is a crash, and so the Maker loans should diminish by 80% to kill the surplus buffer, and that's thanks to the diversification. Because when Maker loans diminish, USDC does move. So we can take more risk.
Got it. Yeah, thank you for that illustration. Makes a bit more sense to me now. I know that there was a question from Frank What are some other ways to increase the surplus buffer? Can we issue a credit card? Just saw Ave tweet a meme of one. No, seriously, any ideas outside of the box?
I mean, the easiest one is to just print Maker, right? But probably there wouldn't be a lot of consensus for it, but like that's the easiest one, definitely.
So basically flip the script. Instead of diluting Maker when it's low, you dilute it when it's high, raise some DAI that way, and go from there. Yeah?
Right. I mean, if you know tomorrow, let's say somebody has a crystal ball and knows there's going to be a 30 million loss tomorrow, we should dilute Maker today when the price is high. But of course, by announcing dilution, the price will already fall. Maybe in balance, it's better to do it, right? But yeah, normally we do that.
Yeah, that is a really interesting concept. Juan says, "Can we dilute a little bit?" But yeah, it is an interesting concept. I know people are definitely not liking the idea of diluting MKR, but that seems to be a far more efficient way to raise capital, especially if we know a very crazy event might be happening in the near future. It would be super hard to get that through governance, though.
I mean, a lot of other protocols are doing that, right? They just inflate the supply, and it works when there's craze going on and people are buying your tokens at highly inflated speculative value. It's totally a valid way to get money.
Yeah, totally.
Yeah, and sadly, we need to wait for Maker to have an insane price, but for no reason, there is never an insane price for Maker. So we need to pump a little bit. But Tesla just did that. I mean, they cannot borrow any money because no one wants to lend to Tesla. And then there was the frenzy, the pump. And so the share price was so high, they could raise $5 billion without too much dilution. Because
right.
Obviously, it's super dependent on the price. If Maker is at 10K, we can raise 10 million, 20 millions. It will not change anything.
Right.
There's one good example of how markets are pretty irrational. So I'm not sure, I may be wrong, but I remember when Land was doing migration to Aave, I think when they announced migration on the new tokenomics, I think they just minted additional 30%. Maybe I'm wrong, but I think I checked that at the time. They diluted by additional 30%. Normally you would think, of course, price should crash by 30%, right? But because there was so much euphoria about the protocol and so on, the price just kept on going on. And it's weird, right? I mean, if we announce tomorrow, we're changing something slightly and we're diluting by, we're just minting under 30% of supply, I'm not sure what happens. But yeah, crypto markets are not rational at all. And I'm not suggesting to dilute Maker, to be clear.
Yeah, I think this year a lot of people are realizing markets aren't exactly rational all the time, and not just crypto markets. I think the big meme happening now is that wait, stock valuations aren't based on fundamentals, and then it's like that astronaut guy, never have been, and everybody's getting a little bit more obsessed with just inflows and outflows of money into assets, and those being the determining factors for valuation. But yeah.
But why would we mint right now? I mean, we have a solid revenue coming in. We are not at the stage where we are, well, I don't know. Are we in a stage where we would be able to spend more money that we can actually make right now? Haven't heard of it yet.
Yeah, I don't think so. And increasing the surplus buffer is a safety, but do we really need it? Because as you say, we are making a lot of revenue, so it will increase slowly but steadily.
Yeah, but my main point is right now, as we don't have any other tool to prevent the buyback program, the stability buffer is the only tool we have. So just this one. So
I'm curious, if you can redesign the Maker protocol with like the snap of a finger and replace the buy and burn with something, what would be your like ideal model?
buy and burn.
You hate it, but you love it.
No, I think it's great. It's just not the right time to do it. I think we are in a very early startup phase, and we should not. Well, the investors are here for the tech on long term, right? Right? So
I fully agree with Tim. If there was one slight change to be made, there is one flaw in the surplus buffer, but I'm not sure there is a solution for that. That will be for maybe Sam to find the solution. Is that having a surplus buffer is very good, and every bank in the world should have a surplus buffer, or what they call equity or capital. So the only issue with Maker is when we trigger the emergency shutdown, we lose all the surplus buffer. Because every DAI holder will have a share of the assets, and not up to $1. If it's more than $1, they get more. And Maker holders, we get 0. So we pay we pay too much to the DAI holders in this case. And that's also an issue with the surplus buffer.
Yeah, that's actually a really good point. Yeah. I would probably fall in line with you, Seb. That's probably the one thing I would reconsider in the redesign. But yeah, it seems like it really is just a game of being strategic and timing and having like a way to do things wisely. Strategic patience. All right. Well, we're coming up on the last like 3 minutes of the hour. Is there any particular question or point that any of you want to make sure is covered? Yeah, go for it, Tim.
Please go vote, both in the Signal request as on-chain. There are just, I don't know, like 30 or 40 wallets voting. This is insane. We need more participations, even from people who are just mute on the forum or in the chat, like I was for a couple of years. Go participate, go educate yourself. And yeah, if you're a shareholder, it's your duty to vote. It's not an option.
Yeah, thank you for that, Tim. I agree. Go vote, even though it might cost a lot in gas sometimes. Well, maybe if you have like 0.1 MKR, you can get away with not voting. But if you have 1 or more, half or more, go vote. No, I'm actually very excited for the governance contract redesign. Yeah, as Tim mentioned, we need delegation. Yeah, that's going to be a good evolution in the protocol. Well, we're coming up at the top of the hour, and it looks like we covered quite a lot of ground here. This was a really interesting conversation. And so, again, I just want to thank each of you for coming on the call and all of the viewers for hanging out with us and listening. And I hope this was valuable, educational for many of you. And yeah, if you're interested in proposing that we cover something in this community call more generally, feel free to message me or DM me. I'm always open to requests. And so, yeah, I'm pretty happy that this panel happened. So thank you all for coming on.
Thanks, David. It's fun.
Yeah.
Thanks, David.
Cheers, everyone. Have a fine Tuesday.
Bye.